chip stocks are favorites of low-risk investors, individuals who may want to participate in some stock market gains, but not risk the farm to do so. These companies often pay dividends too. While volatility in the stock market is simply something investors must accept, 2020 was a harsh reminder of that reality. Some stalwarts of the industry can still offer more peace of mind than the average stock. Here's a look at 7 of the best blue chip stocks to buy for 2021. Let's get into the video. Number 1. Apple. Apple is one of the largest companies in the world, and it's been a pioneer in the technology sector throughout its history. With an array of products from its innovative Macintosh computers in the 1980s and the iPod portable media player in 2001 to its ubiquitous iPhones, iPads, and Apple Watches today, Apple has won a core following of customers around the world who flock to buy its latest products and will not be ejected from its top position in consumer electronics anytime soon. Apple also earns recurring revenue through its services, which include its groundbreaking iTunes, App Store, and streaming television businesses. Apple's market capitalization climbed above the $1 trillion mark in 2018, and it's still growing. In the past 10 years, the stock price has risen by 1,017%, including a doubling in the past year. In short, Apple shares have brought shareholders a huge profit, and that will probably be the case in the future. The iPhone, which is now in its 12th generation, remains the best-selling mobile phone in the world. In addition, Apple has expanded its business into new markets such as TV and movie streaming and online payments, and the long-held plans to develop an electric vehicle are still alive and kicking. Number 2. McDonald's. Despite being around since the 1950s, McDonald's has always found a way to adapt to change. In fact, during the past few years, the company has been involved in a major restructuring, and the effort has been spot on. Some of the moves have also been key for dealing with the COVID-19 pandemic, such as installing automated kiosks, implementing digital technologies, and improving drive-through service. In the most recent quarter, the company reported adjusted earnings of $2.22 per share and revenues of $5.42 billion. This beat the Wall Street consensus of $1.91 per share and $5.4 billion in sales. There was also continued improvement in global comparable sales. Part of the success came from promotional activities like the Famous Orders campaign, which featured orders of musical stars like Travis Scott and J Balvin, and also the launch of the Spicy Chicken McNuggets, as well as the McPlant. It certainly helps that the company has a strong balance sheet. This has also allowed for a competitive yield. The dividend is 2.45% on MCD stock. Number 3. Nike. The apparel industry is brutally competitive, but one of the few ways to stand out is to have a premium brand, and this is certainly the case with Nike. Its iconic swoosh is nearly universal and remains as fresh as ever. In Nike's core market of athletic shoes, the company is the clear dominant player. In January, the company announced that it brought on John Donahoe as CEO. It was a recognition that the future would require a strong digital strategy. This U.S. sportswear and footwear giant is ideal for investors looking for an undervalued blue chip stock to add to their portfolio. Nike, which posted sales of $37.4 billion last year, is the world market leader in sports shoes. In addition, it has negotiated lucrative marketing deals with the world's biggest sports stars, including LeBron James, Cristiano Ronaldo, and Rafael Nadal. Still, the stock is on a paltry 10% profit over the past year, and the current price is lower than the price targets of analysts on Wall Street. A great buying opportunity indeed. Number 4. Disney. Disney stock has done quite well this year. The shares have actually posted a marginal gain, even though the company has posted large losses. Consider that Disney has doubled down on its streaming effort due to the pandemic. As a side of its importance, the company has suspended the dividend payouts so as to provide even more financial resources for Disney+. As of early October, the service had over 73.7 million subscribers. This was up by more than 10 million since August. Disney also offers a bundle with other streaming services like ESPN+, which has 10.3 million subscribers, and Hulu, which has about 36.6 million. But the success of Disney Plus is a clear sign of the agility of the company's organization. The service is also likely to be transformative, providing a rich source of recurring revenues, making it possible to have more direct relationships with customers. It will also have a big impact on the rest of the businesses when things start to improve next for the global economy. 5. Microsoft. Among blue chip stocks, Microsoft is one of the younger ones. Bill Gates and Paul Allen founded the company in 1975. They were smart to focus on building operating systems for PCs, which quickly turned into a massive business. But the situation changed in a big way when Satya Nadella took the CEO post in 2014. He wasted little time unloading non-core businesses and focusing on the main strengths of Microsoft, like its loyal developer ecosystem. He was also smart to invest aggressively in the Azure cloud business, as well as to acquire companies like LinkedIn and GitHub. The result is that MSFT stock has been a big winner. From 2014 to 2020, the shares have gone from $40 to around $214. The market capitalization is $1.6 trillion. The COVID-19 pandemic has also been a catalyst for growth. Companies have had to scramble to manage remote workforces, and Microsoft's Teams video conferencing platform has seen a huge surge in demand. There are 115 million daily active users. But there has also been growth in the Xbox division and PCs. In the meantime, Microsoft continues to be a cash machine. During the past year, the cash from operations went from $52.2 billion to $60.7 billion. Number 6. Amazon. This tech giant has been very busy during the last decade. Amazon has made crucial acquisitions central to its expansion goals, launched products that integrate well into the industry-leading ecosystem, and, most importantly, managed to bring its bottom-line growth to the level benefiting its top-line growth. Amazon has forever changed the way we buy goods and services. The pandemic has accelerated the transition to online shopping, and it is now an indispensable part of our lives. So you can count on Amazon to continue to dominate online shopping for years to come. While Amazon has done well in the past 12 months, gaining 43% price to nearly $3,400, there are many analysts who consider the stock undervalued at its current level. At least one analyst has a price target of $5,700 for Amazon, which means that the price can still go up 70%. In the long term, nobody can ignore Amazon. Also, because it is further expanding its market leadership in cloud services through Amazon Web Services, or AWS. Number 7. Bank of America. Rock-bottom interest rates and the COVID-19 pandemic have weighed on the banking sector this year. But the mega operators have been able to weather the storm because of their economies of scale and diverse businesses. And one of the blue-chip stocks of the sector is Bank of America. Even with the headwinds, the company continues to be highly profitable. In the latest quarter, the profits came to $4.88 billion, up from $3.53 billion in the previous quarter. One of the nice growth spots has been investment banking, which was up 15% on a year-over-year basis. The main driver has been the IPO, or initial public offering market. Bank of America has been investing heavily in its digital platforms. The company's AI virtual assistant, Erica, has 15.9 million users, and the Zelle Payments app has 12.2 million. Keep in mind also that the company has applied for nearly 4,400 patents on its technologies, and about 275 have been granted this year. The digital systems will not only help to lower costs, but also provide much better consumer experiences. As for BAC stock, it is trading at only 14.5 times earnings, and the dividend is roughly 2.5%. And in a sign of confidence, Warren Buffett's Berkshire Hathaway recently acquired $2.1 billion of the shares. High conviction ideas? You bet. But as Buffett said, when it's raining gold, reach out for a bucket, not a thimble. These are fat-pitch hyper-growth blue chips that are just one catalyst away from a potential large earnings. It's time to stop praying for luck on Wall Street and start making your own. Not through market timing, but through a disciplined application of financial science. Leave a like and subscribe if you enjoyed this video, and tell us your top picks for blue chip stocks in the comments.